If I had to buy 4 stocks and hold them all the way till 2030 or for the next 5 to 10 years, I would have to make sure that these stocks would either benefit from long-term cyclical tailwinds, so think of industries like robotics, automation, blockchain technology, or self-driving, or I would have to make sure that they're part of industries that are evergreen. These are industries that are not getting disrupted and are not going away anytime soon. So think of things like waste management, oil drilling, or even construction. Now, the problem with chasing stocks that are in long-term cyclical tailwinds is that these stocks are typically priced to perfection. So if you look at some of these stocks on the screen here, like D-Wave Quantum and IonQ, they're part of the quantum industry. And these companies, for the most part, are pre-revenue. They're not generating any money at all, but are still priced at multi-billion-dollar market caps. This means that these companies have no room for error and are already priced to perfection because everyone knows that they're going to be part of long-term cyclical tailwinds. And the same thing can be said for Palantir. Even though Palantir is a phenomenal company, the stock is priced to perfection. So any type of slowdown in their growth in the future will cause the stock to crash. And I can say the same thing for Nvidia as well. Even though it's part of a massively growing industry like semiconductors and data center GPUs, the stock is priced to perfection. So not only do we have to pick the right industries, but we also have to pick stocks that are priced at fair values today. And so that's exactly what we're going to be doing in this video. We're going to look at some of the top industries that I choose to invest in, and I'll be looking at my favorite stocks in each of these industries. And the first industry I want to talk about is the buy now, pay later industry. So this is a product and service you guys have probably all heard of, and maybe some of you have even used, because it's experiencing a 24.3% CAGR per year, and that growth is expected to continue all the way until 2030. And this was one of these rare technological innovations that didn't actually take off in the United States first and then spread all over the world. It's actually one of those things that took off in Europe first by a company named Klarna in Sweden. So they were launched in 2005, but they really started popping off in 2011. And so the BNPL industry, let's call it, really started growing in Europe, and now over the last 5-6 years it's really starting to spread in the United States, and we can see that in the numbers here. So in 2020, the market penetration of BNPL transactions was 7.4%, and that grew to 13.6% in 2024. So that's almost a double, or a little less than a double, in 4 years, which is still great growth. But in North America, the growth went from 1.6% to 4.5%, which is almost a triple in that same time period. So although the share of BNPL transactions is much smaller in North America, it's growing at a much quicker rate, which is exactly why I'm looking for an American company in the BNPL space. So now let's quickly explain how the BNPL business model works, and then I'll reveal the stock and why I think that stock is different from all the other companies. So some of the more famous companies in the United States are Affirm and Afterpay. And so they have this similar business model, and then the stock I'll reveal later has a slightly different business model. So how it works is, let's say you're the customer, and let's say the merchant is Nike. So you want to buy, let's say, Nike shoes for $100, and Nike has a partnership with Affirm, which is the BNPL provider. So how it works is you place an order, let's say on the Nike website, for a pair of shoes at $100. And then that company ships that order to you, and you don't actually pay anything. So what you do is you just place the order, and then you use Affirm services, and they're the ones who pay the merchant. So you place the order, you get the shoes, and you don't pay a single dollar. Instead, the BNPL provider, which is Affirm in this case, they would pay the merchant the $100. So you're basically getting the pair of shoes without paying a single dollar. And then what you do is, over say the next 4 months, you pay Affirm back the $100 over, let's say, four installments of $25 each. So and you don't pay them any interest fee expenses or any fees or anything like that. So you're paying that $100, the same $100 you would have paid otherwise, but you're getting to pay it over 4 months. So you're happy because you get to basically finance your shoe purchase for free. And the merchant is happy because they're getting more business from people like you who wouldn't otherwise be willing to pay for it. Now, the only person who's not very happy is the BNPL provider, because they're not making any money from you because, again, you're just paying them the $100. Instead, they're making money from the merchant, and they charge the merchant a merchant fee, which is 5%. So from every transaction, the BNPL provider like Affirm charges the merchant like Nike 5%. So, and this is not a great business model because they're taking on all the risk. Because let's say you don't pay them back, then the BNPL provider is the one that kind of has to take the brunt of that hit because no one else is liable. Like, the merchant doesn't care because they already received their money. So they're taking on all the risk, and they're doing all that just for 5%, which is exactly why this business model, even though it's great for the customer and it's good for the merchant, it's pretty shitty for the BNPL provider. And that's why companies like Affirm and Afterpay are deeply unprofitable. And this is where Sezzle comes in, where they're kind of going for a new approach, something that's much more profitable and that's experiencing much more revenue growth. So We started buying this company in February of February 26th of this year. And it says here I bought it at a price of $292 per share, but this was before the stock did a 6-for-1 split. So I was basically buying it at $40 a share, and then I bought it again here at a bit less than that, I think at $36, $37 a share. And then we sold it all the way at the top at around $160 per share. So we kind of traded in and out of this company, but I've always held a pretty strong position in it. And most recently, right here, the stock got cut in half from $180 all the way to $92 a share. And so we made a recent purchase at $101 a share. So I'm kind of just showing you that I'm putting where my money where my mouth is. And I've been in this stock for a long time. I made a bunch of money on it, and I still hold the position today. And I recently bought it just around 2 weeks ago at $100 a share. So this is what makes Sezzle different. They have 3 different transaction types, let's call them, and they make money in these 3 different ways. So number 1 is Sezzle Merchant. This works exactly the same way as I explained to you with companies like Affirm and Afterpay. So when they're partnered up with a merchant, they charge that merchant 5%. But you can only use that service when in places that are partnered up with Sezzle. Just like how you can only use Affirm with companies that are partnered up with Affirm, like let's say Nike is partnered up with Affirm, you can only use Affirm at Affirm partners. Sorry if that was a bit complicated. So that's the same thing with Affirm. Nothing special here, that you can only use this with companies that are partnered up with Sezzle, and they make money by charging 5% merchant fees. Now, what Sezzle did that was so revolutionary is a product called Sezzle Anywhere. So how this works is you download the app and they issue you a Sezzle Visa card. And so you can basically, with this card, you can use the Sezzle services anywhere in the world where Visa is expected. It does not have to be a merchant that's partnered up with Sezzle. And this is exactly what makes it so different, and exactly why they've been able to acquire so many new users, because this is a revolutionary product. This lets you use buy now, pay later anywhere in the world where Visa is accepted. But the bad news is for Sezzle and Sezzle investors is that they don't make any merchant fees here. Because remember, they're not partnered up with these merchants. So let's say they're not partnered up with a company like Walmart. You can still use Sezzle Anywhere in Walmart, and they don't make any merchant fees because, again, they're not partnered up with Walmart. So instead, how they make money from Sezzle Anywhere is by charging you a service fee every time you use their card. And this is a very small $1 service fee. So it's a very much a low margin business for Sezzle. But the reason why it's been so successful is because it's been able to acquire so many new users, because people want to use buy now, pay later, but they don't want to be limited to only the merchants that are partnered up with the BNPL providers. And so then once Sezzle sees that you're frequently using Sezzle Anywhere, they start upselling you Sezzle Premium, which is a subscription model product. So you pay $12, $13 a month, and then you start getting benefits like discounts, reward points, and cashback. So this basically acts like a credit card, where you know how credit cards give you reward points. Sezzle Premium gives you all different types of perks, like again cashbacks, reward points, and discounts. And this is exactly why Sezzle has been able to become so profitable, because of this product right here. Because subscription revenues are the best types of revenues you can have, because again, they're recurring and they're consistent. You can predict them very easily, and that's exactly how Sezzle has been. First of all, has been able to get so many new users using Sezzle Anywhere, and have been able to be so profitable using Sezzle Premium. And remember, companies like Affirm and Afterpay are so unprofitable. It's unbelievable how much money they're losing, versus a company like Sezzle, which is a much smaller company, but they're already so profitable because of this business model exactly. And we can see it in the numbers here. So they've been able, in Q2 of 2025, they've been able to grow active users by 60%. So that just shows how successful Sezzle Anywhere is being. And again, once they see people using Sezzle Anywhere very frequently, then they upsell them to Sezzle Premium, which is their most profitable product. And we can see it again in the numbers here. So in 2024, they did 70% revenue growth. And in 2025, they're guiding for 60 to 65% growth. This is insane levels of growth for a company like Sezzle. And they're guiding for $3.25 in EPS in 2025. And so we're going to use these figures to come up with a valuation model. So again, $3.25 in EPS, and the stock is trading at $95 a share. That's a 29 times price to earnings ratio for a company, again, that's growing revenues at 60 to 65%. So to me, this is one of the best deals in the entire market. This stock is being so overlooked because people just don't really know about it, because it's just a small company in the BNPL space, and it's only now really starting to take market share from the competitors like Affirm and Afterpay. So again, a stock growing at 60 to 65%, trading at 29 times price to earnings ratio is a phenomenal deal for me. And this is me running the valuation model for it. So again, we put $3.25 in EPS, and I'm expecting EPS growth to be 35% 2026 and then start slowing down. So even though it's 60 to 65% this year, I'm taking super conservative estimates and assuming that it'll drop down to 35 and then all the way to 20% growth in 2030. And I'm using an exit multiple of 20 times. So I'm assuming that in 2030, the multiple will drop from 29 times today to 20 times in 2030. So that's a big multiple contraction, and it would mean that the stock is trading at a 1 times price to earnings growth, which I think is super conservative. And even using these massively conservative estimates, we can expect 16.6% returns per year from now until 2030, which I think, again, these are super conservative estimates. I think we can easily do 20% returns per year on a stock like Sezzle. So the next industry I want to talk about is the garbage industry. So this is one of those evergreen industries that I think is not going away, because whatever happens, no matter what type of technological innovations we have, no matter what's happening, any type of policy changes, the only thing that can change is how this garbage is being collected. But the point is that garbage will need to be collected now and in 20 and in 30 and in 40 years. And even though the waste management market is only expected to grow at 5%, if you choose a high quality company in this industry, you're going to make a killing. And my pick for this industry is Waste Management, which is one of the highest quality companies in the entire market. And over the last 5 years, they've been able to return 98%, which is almost 20% a year, to shareholders, and that's excluding dividends. And they have it in their presentation right here, and they talk about it. The returns for waste management have been resilient through political administration changes, policy changes, pandemics like the COVID-19, labor shortages, wage inflation. So even though this company is not going to return 20% a year like Sezzle is, it's going to return much less than that. But why this is such an important part of my portfolio, companies like Waste Management, is because they bring stability to my portfolio. So when the market sells off and when we have a bear market and the market is down, let's say 10, 20%, the S&P 500 is down 20%, stocks like Sezzle and high beta stocks, high growth tech stocks are going to be down way more than 20%. They'll be down 30, 40, 50%. But stocks like Waste Management will actually not even be down as much as the S&P 500 because they're such low beta stocks. And so what this allows me to do is when the market sells off and Waste Management is holding up well or maybe even going up, I can sell Waste Management, take profits, and then use that money to buy the dip on high beta stocks that are down 50, 60%. And this is part of the strategy I use to consistently beat the markets. So I'm not going to talk too much about Waste Management as a company because it's a pretty straightforward business. They collect your garbage, but they're projecting $29 billion in revenue by 2027. And so that's number one. They're projecting $29 billion in revenue by 2027. Number two is they're buying back almost 1% of their shares per year. And number three, they have a 1.46 annual dividend. So if we add those up, that would represent a 10% revenue growth per year, 1% share buybacks per year, and 1.46% dividend yield per year. So you add those up and you get 12.46% returns per year. That's assuming that the multiple doesn't expand, which I think could very well expand over the next 3-4 years. So you're getting 12.46% returns very safely on a stock that has very low beta, which means it's not going to crash 40-50% like Sezzle, for example, which is exactly why I think companies like Waste Management should be a part of your portfolio because they act as an anchor and then as a stability to your, let's say, high growth portfolio like I do. Most of my stocks are super high growth, and that's why I balance that with a few stocks like Waste Management that can anchor my portfolio down and that I can use to sell off when the market sells off. These stocks will hold up well, and I can use I can take profits on a company like Waste Management and use the proceeds to buy high beta stocks like Sezzle and Hims when they're down 60% from their all-time highs. The next industry I want to talk about is the telehealth industry. And this is one of the fastest growing markets in the United States. I mean, because especially with the growth of technology, people are finally starting to realize that we don't need to go to the hospital for every single thing we need, right? And that's why the telehealth market is expected to grow at 23.8% per year from now until 2030. And my pick for this industry is Hims and Hers Health, which is a company that I've been buying ever since it was trading at $15 a share. And even though I took some profits at the highs at $70 a share, and you can see that in my exclusive Discord, so we're still up massively on this position, but even now at $40 a share and $45 a share, I made a purchase very recently at around $45 a share. I still think it's providing great value for investors. And so now let's quickly talk about the business model and what they do. So Hims and Hers Health operates in weight loss, sexual health, dermatology, mental health, and they're getting into hormone health and longevity. And they're mainly operating in the United States and in Europe, but more recently they're expanding internationally to countries like Canada as well. So what a lot of people think Hims and Hers does is they think they buy drugs from drug manufacturers like Novo Nordisk, for example. They buy the drug for $1 and then they sell it at $1.50, and then that's how they make their money. But this is false. This is not the business model of Hims and Hers. Hims and Hers' business model is in the their business is to personalize these drugs. So they get these generic drugs, and let's say you want a hair loss treatment like minoxidil, for example. But let's say you have some sort of allergy to something in the minoxidil product. So what Hims and Hers would do is they would take the minoxidil product, they would remove the elements or the chemicals that would make you allergic, and then they would sell it back to you. So they're basically making these drugs and the medicine that they're selling to you, they're making it personalized to your needs, to your side effects, to your allergies, and then that's what makes Hims and Hers so special. And they have 4 facilities all around the United States that help them do this, that help make these drugs personalized. And that's exactly what makes them different. And then they ship it to your home in a nice box like this. And that's exactly what makes Hims and Hers not just a random telehealth company that buys the drug for $1 and then sells it to you for $1.50. They buy the drugs, they personalize them to your needs, and then they sell it back to you at a profit. And that's what makes Hims and Hers so special. And that's part of the reason why they have 47% market share in this industry, because they're personalizing these drugs for you. And people like that. People want drugs that are personalized to them. They don't just want the generic stuff because they don't want the side effects. Let's say they have allergies. They don't want that. They want the drug without side effects and without allergies. And we've been able to see this in the number. In the last quarter, they reported 31% year-over-year subscriber growth and 73% revenue growth. So even faster than they're growing even faster than Sezzle, which is 73% revenue growth is super impressive for a company like Hims and Hers Health. And it's part of the reason why I like this company so much. And finally, for the valuation model, I'm going to take management's word for it. And they're guiding for $6.5 billion in revenue in 2030 and $1.3 billion in EBITDA in 2030. So if I take that $1.3 billion right here and I subtract taxes and amortization and depreciation, I can expect around $1 billion in net income. And then I'm applying an exit multiple of 25 times earnings, which I think is super fair for a company growing as quickly as Hims and Hers is. And then so in 2030, we get a market cap of $25 billion in 2030. And then we discount that back to today, which then the market cap today is $9.5 billion. And we get an annual return of 21%. If you assume the management estimates are correct, you can expect around 21% returns from this company per year from now until 2030, which I think is a phenomenal deal. Like 20% is a very good return that you can expect from a company like Hims and Hers Health. The last industry I want to talk about is the defense industry. And ever since the last 4 or 5 years, we've I'm sure you guys know we've had a few wars. Countries are finally starting to realize that they need to up their defense spending. And US, for example, we can see it in the chart here. In 2026, they're expecting to spend massive amounts of money on defense. And countries all over the world are starting to realize that, hey, like countries in Europe are starting to realize, hey, we can't just rely on the United States for our protection. We need to have our own armies. We need to up our defenses. And so that's why you're seeing companies like Germany, Russia, and Ukraine massively up their military spending. And China has always been a big spender on military. But even countries like India, for example, they have their own beef with Pakistan. So they're massively increasing their spending, and Pakistan is massively increasing their spending as well. Even in the Middle East, every country that has the capability to do it is massively upping their military spending. And a lot of that money is going to Lockheed Martin. So Lockheed Martin is a boring company. They're not a fast grower. They're one of those evergreen stocks that I believe provide good stability to your portfolio. And the big reason why I like this stock is because they have a record backlog of $176 billion. So even if, let's say, countries for whatever reason, which I don't think is going to happen, I think they're only going to increase their spending. But let's say for whatever reason, they start slowing down their spending. Lockheed Martin already has a record backlog of $176 billion, which is almost 2.5 years worth of revenue for Lockheed Martin. So they already have 2.5 years worth of revenue secured in the bag. And that's part of the reason why I like the stock so much. So for the valuation, they're buying shares at 4% per year, and they're growing revenues at 4.5% or 4.6% per year. So right over here, share buybacks of 3.9%, revenue growth of 4.6%, and a dividend yield of 3%. And so you add that all together, 4.5% revenue growth, 4% share buybacks, and 3% dividend yield is around an 11.5% yearly growth. So although 11.5% yearly growth is nothing to write home about, it's not great. Again, this provides stability and an anchor to your portfolio. This is the type of stock that will do well during bad times. So when the markets are crashing 20-30%, a stock like Lockheed Martin will probably be either flat or maybe even up. And then you can sell the stock and buy more of stocks that are dipped 50-60%. And that's exactly what I like, why I like companies like Lockheed Martin and Waste Management. The next stock I want to talk about in the defense space is Firan Technology Group. Now, this is a company that I haven't done much research on because it's only been put on my watch list or on my radar yesterday, so I haven't done too much research on it. But up until now, from what I see, this company is super impressive. So first of all, what they do is they sell circuit boards and electronic products to companies like Lockheed Martin, to companies like Boeing, to organizations like NASA. So they create these electronic products and then they sell them to these big conglomerates like Lockheed Martin and Boeing. And over the last, call it 4 years, they've been growing their revenue at 30.8% per year. So their revenue growth has been massive over the last 3-4 years. And they're only trading at a forward PE of 19.4 times. So this is why this company has been super interesting to me, because they're seeing massive growth, 30% plus per year, and they're only trading at 19.4 times PE. But again, I don't own this stock and I haven't done too much research on it. So it is one of the more, I guess, risky stocks because I don't have much conviction on it because I haven't done enough research on it. But I decided to just put it on your guys' watch list because I thought it was super interesting. So I hope you guys enjoyed this video. This video took a lot of time, a lot of research to put together, and I'm sure it's a pretty long video already. So I hope you guys enjoyed it. If you have any questions, don't hesitate to ask me in the comments down below, and let me know what you guys think. Are these good stocks or are they shitty stocks? And I guess we'll find out in 2030 if I perform well or not.